So let's go back to inflation and rates specifically. On the one hand, I mean, we have a number of different factors at work. We have the Federal Reserve raising rates, and you were very outspoken about the Fed's commitment to raising rates at a time when others were unsure about it. Back early in the year, you proved you were right. And this week, you know, we need look no further than comments by all the Fed officials who've spoken about the fact that they want to raise rates. Now, but what I was going to get into is, tariffs, right? So that's raising prices. We've got wage growth accelerating and rising interest rates. What impact is that going to have on companies' ability to earn?
Well, I think the bond market and the stock market are telling you different things, right? The stock market is selling off because it's worried about the Fed and potential inflation. If you look at the bond market, though, what it's telling you right now is 75% of the increase in rates year to date in the long end, the 10-year, where we price mortgages and things like that, that's actually all real yields going up, i.e. the market is saying growth is stronger. Only 25% of the increase in rates has actually come from inflation expectations moving up. So if you're the central bank, you're actually okay with that. It's not, inflation expectations are not getting untethered. I think what I would focus on, and this ties into my comments earlier on trade to kind of bring them together, when we get into 2019, I would make the prediction that we see margin degradation in many companies. So there's going to be a movement. Thus far, a rising tide has lifted all boats. We're going to have a world of kind of what I would say is price makers who can set price and put the costs through, including wages, interest costs, and oil, and those that can't. And that has not been where we are, and that's going to be a change.
How does KKR translate that into money? How do you make money?
Well, look, we're trying to do a good job for our LPs, and I think one area that we're very focused on right now, you guys have reported, we've really expanded our footprint and infrastructure. We are trying to get focused on, as this shift from monetary policy to fiscal, to own more assets that have cash flowing yield up front that are linked to GDP. There's a secular shift away from monetary policy as it ends towards fiscal policy, and there's a very clear investment action, which is get long things that are linked to nominal GDP. We're doing that in our credit business, our infrastructure business, our real estate business, our energy business, so, and to some degree in private equity. And then on the defense is just make sure you don't get wrong-footed on wages and margins, and so that's where we're focused.